Good afternoon. Today we would like to discuss a new chapter under third module, that is debt to market. It's a very simple area. I think all of you have covered all these things in your degree syllabus. So let us start with meaning. Debt market. We know it's a market meant for trading fixed income instruments. People are always using this instrument for ensuring fixed income from the investment. Debt market refers to the financial market where investors buy or sell debt securities, mostly in the form of bonds. There are two instruments are dealing in this market: bonds or debentures. Indian debt market is one of the largest debt market in Asia, not Indian debt market is one of the most largest debt market in our Asian region. Okay, so definition of bond or debt. Bond or debt can be defined as a loan for which an investor is the lender. The issuer of the bond pays the investor interest in return for the funding. It's clear. The maturity date refers to the date on which the issuer has to repay the principal to the investor. So there is a maturity period, there is a fixed rate of interest, there is a principal amount. There are three concepts behind these definitions. Okay. Then there is slight difference between debt and equity. We know equity. When an investor invests money in equity, he becomes the owner of the corporation or a company concerns. He also gets some voting right in the company. This is a basic difference between this bond and equity. When a person invests in equity shares or equity, he becomes the owner. And also he has the voting right. In the case of debt, the investor becomes the creditor of the issuing company or issuing a corporation. Investor will be the creditor. As a creditor, he has the higher claim to the assets of the entity as compared to the shareholder in the event of the company. Clear? There is no voting right. There is no question of voting right. There is no profit share. Nothing. Only the creditor. Clear? So this is the basic difference between this debt and equity. So let us see what are the features of these debt market or debt instruments. First one, as we have discussed, fixed return is a very important feature of this debt instrument of Indian debt market is the return that is fixed in nature. Fixed rate of return is then risk free as compared with other instruments. Almost risk free. Then there is, as we have discussed, there is a rate of interest. Fixed return on the bond, that is called fixed rate of interest or coupon rate or interest rate, whatever name, is the amount of the investor will receive interest payment. Clear? That is fixed in nature. There are two kinds of interest rate, fixed or floating. In case of floating fixed rate, interest rate may be adjusted by the issuer if required. There is changing. Okay. The next issue price. Issue price is bond may be issued at face value or at a discount value or at a premium. Okay. Inverse issue price means it may be bond may be issued at a face value or par value or at a discount to the face value. Investor should also keep in mind that the price at which the instrument trades in the market is not the face value. Please remember, investor should also keep in mind that the price at which instrument trades in the market is not the face value, it is market value. The price of an instrument can keep fluctuating throughout its life based on the market forces, demand and supply. Clear? So if it is trading below the face value, it is called issue at discount. Clear? So this is the issue price. Then maturity in debt market. Maturity means is the date on which the investor repaid the principal value to the issuer. The date. It may be vary from 1 day to 30 days. or 30 years or months, whatever may be. Based on the period, it may be long term or short term or medium term, whatever it is. Okay. Then when the period is higher or longer, interest will higher. Okay. The next issuer. Issuer means any corporate or a government that issue a fixed income security, that is called issuer. Issuer means an entity or a corporate or a government who issue a fixed income security to the investor. Clear? Then next one, determination of price. That means the price of the in instrument, that is debt instrument, in debt market is based on the market. Market means demand and supply. The price of the instruments is also governed by changes in the economic conditions, market conditions, money market condition, changes in interest rate of new issue, etc., etc. So these are all the variables or the factors that will affect while we are while determining the price of the bond. The next, maturity at face value or par value. Face value is the amount the investor will get back from the insurer once the debt instrument matures. That is the face value at maturity at face value. Then let us see what are the risks related with investment in bonds. We are already said that it's almost risk free. There are 3 or 4 risks. First one, interest rate risk, credit risk, liquidity risk, call risk or reinvestment risk. Interest rate risk means prices are inversely related to the interest rate. When the interest rate is higher or rises, bond price will decline. That is the inverse relationship between price and interest. When the interest rate go up, price will down. If we need to sell our bond in higher interest rate, we may get some less than what we have paid. So this is the risk related with the interest rate. And another one, that is credit risk. That means suppose an issuer faces a financial crunch or a bankruptcy. What will happen? He may default on payment towards this instrument. So this is a credit risk. It's a common phenomena. Okay. The next, liquidity risk. Liquidity risk means suppose if the coupon rate is lower than the prevailing interest rate. If the coupon rate or interest rate is lower than the prevailing interest rate in the market, what will happen? The investor is or may automatically find it difficult to sell the instrument before the maturity, only because of the prevailing interest rate. Clear? So debt instruments are generally more liquid during the initial period after they are issued. Once again, if the coupon rate or interest rate of our debt market is lower than the prevailing interest rate, what will happen? Investor is face a problem, that is, it is very difficult to sell the instrument before its maturity. Clear? Then one more risk, that is call risk. Call risk means it is also known as reinvestment risk. That means for a bond with a call option, the issuer may redeem the instrument prior to the maturity as per the predetermined dates and price for such a trade. I will give it clearly. Issuer always normally redeem such bonds when the interest rate is falling. Normal case, issuers normally redeem such bonds when interest rates are falling, and as a result, what will happen? Investors have to reinvest their fund at lower rate. Clear? This is the risk related with the reinvestment. So that's all about risk. Okay. By these words, let us conclude today's class. Thank you.